Hi, this is Steve Hutchinson with Hutchinson Family Office, and it's been a while since we've done a video, but a lot's been going on in this year and also too last year, and so I wanted to bring you up to date on a few things that we're considering. Right now, I've got three things I want to discuss. But first, I want to talk about our special Outlook 2018 conference. It's going to be at Grandover on Thursday, March 15th. Details will be coming to you in the emails and also a letter. So be on the lookout for it. We're looking forward to getting together with you and sharing with you our ideas. We're going to be talking about trends, tax law changes, very important tax law changes, how they're going to affect you for this year. We're going to be talking about risk we see, and also opportunities. And I think it's going to be a great conference, and we're really looking forward to sharing with you our ideas. Let's talk about the three things I want to discuss today. Well, the first one is going to be basically the markets and their general perception today. Generally, it's undeniable that the financial markets have moved significantly since mid to late November 2016. And in that process, the markets have gained tremendous amount of momentum, and we've seen very, very strong performance in your 401ks, your IRAs, your managed accounts, and we've been very pleased up to this point with the results. What we're going through right now is a correction, and a correction is normal. And let me explain to you how these corrections take place. They don't generally take place because we perceive that valuations are high. They take place because, generally speaking, larger institutional investors want to take off risk positions. Now, there's been some derivatives that have been built into the markets over the past few years. And a lot of these are called ETFs, exchange-traded funds, and a lot of things tied into volatility indicators or volatility funds. Some of these are highly leveraged, and people use those. They sell them short for income, or they go long in them to hedge a position. When these derivatives start unwinding, we go back to something we saw in 1987, which is what we call program trading. Now, I would venture to say that the majority of folks that we work with were not heavily invested in the market in 1987, but it was still there. And program trading was responsible for a lot of the decline in 1987. It had very little to do with valuations. It had all to do with technical issues that investors wanted to get out. So quite frankly, corrections are normal, and we should expect it. And so far, this correction has been normal. It's been about 10%. We've sent emails back and forth in our office about where we expected the bottom to be, and pretty much we were within a few points of where the bottom was. Have we seen the end of it? No. Corrections do funny things. They try to seek a level, and so we would not be surprised. Yesterday, on the filming of this, we saw the market jump up 500, almost 600 points or something like that. We wouldn't be surprised if it pulled back a little bit of that. We wouldn't be surprised if it went back down and tried to take out its lows from originally. So we're not too concerned there. What do we expect from here? Well, we focus on the fundamentals, and as you know, the way we manage our portfolios, we hold in companies, we invest in companies, we don't trade them. That's not our role. And so our portfolios are designed, if you will, designed on what we call 5 different sleeves. And each of these sleeves are independently managed, and then they're put together to accommodate the level of risk perception that you're willing to take in your portfolio. So what we expect from this point on is really nothing has changed. We went on record saying that we believe that the financial markets would return somewhere in the 10 to 12% range this year. We believe that's going to be powered by stronger earnings. We think that the dollar will continue its strength. We're starting to see a tick up in wages. We're also definitely seeing a decline in unemployment, and also corporate earnings are very, very strong. So that reinforces our philosophy as far as where we're going to go from today. The tax law changes, though, will have a positive impact. And I want to take you back to 2008, 2009, which a lot of times we have a difficulty remembering those times. In 2008, 2009, under the previous administration, it was pushed through a $1.5 trillion stimulus package. And the stimulus package was basically flittered away with pork, crushing cars, things of that nature, and really did not do anything for the economy. I think the best way to look at the tax law change from last year and as it moves forward for the next few years is going to be that it's more of a stimulus package. And that stimulus was spread out as far as it could have been spread out. It was given large corporate tax cuts, which were well needed, very much needed to make our corporations more competitive, to attract business here. And individuals received some tax relief, okay? Tax relief could have gone further, but because this was passed in a very separated Congress, if you will, none of the opposing parties voted for the tax law. They were unable to bring to the floor anything that would be meaningful for you as far as your income tax goes. But the impact of this is going to be tremendous. 1.5 trillion of stimulus will have an impact on the economy. In fact, so much so that the Atlanta Fed just recently came out and said that they expect first quarter GDP, gross domestic product, to grow at about 5.4%. This is tremendous. The last time I saw 5.4%, Ronald Reagan was president, and that's the best I can remember. That's positive. That raised some fears for inflation. What will the feds do? Things of that nature. But generally speaking, the economy is strong. Earnings are strong. Business is good. So we like to say that stay the course and hold your own. And remember that we're not going to trade in this area. We will take the opportunity when things get a little bit sold off to make some buys of some of the companies that we really believe that are positioned well. But as a general rule, it's not good to react in these situations. So I'd like to convey to you as much, we are not concerned about the correction. We do not believe that this is the end of a bull market. Usually ends of bull markets come from macro changes in the economy, recessions, things of that nature. This is what we would consider a straight out normal correction. But as always, if you have any questions and you would like to discuss this with us, give us a call. We want to talk to you. We want to help you understand where we're going from here. That'll do it. Now, I don't want to remind you, on March 15th, Thursday, March 15th, we're going to be holding our 2018 Outlook Conference. We're going to be covering a lot of great topics, and we're looking forward to seeing all of you at this program. Thank you and have a great day.